Today, we are diving into the Fibonacci trading strategy, or more accurately, the Fibonacci trading technique. I will explain what the Fibonacci sequence is and where the idea of using Fibonacci in trading actually comes from. Second, we will go over how Fibonacci levels are used to detect potential trading opportunities. Third, and most importantly, we will talk about why and how the fact that so many traders watch these levels actually amplifies their impact, and at the end I will share some tips and common mistakes to avoid. This information is not financial advice and is for educational purposes only. Do your own research before making any decision. Let's start with the basics. The Fibonacci sequence is a series of numbers where each number is the sum of the two before it. It starts with 0 and 1. 0 plus 1 equals 1. Now we have 1.
1 plus 1 equals 2.
Now we have 2. 2 plus 1 equals 3. 3 plus 2 equals 5, and so on, go till the end. Now what's special about these numbers in trading? It is not the numbers themselves, it's the ratios between them. When you divide one of these Fibonacci number by the next or the one after that, you get ratios like 0.618, 0.382, and 0.236. Forget the Fibonacci series and its numbers. Just remember these ratios. We use these ratios in Fibonacci trading strategy. These ratios appear repeatedly in nature, art, architecture, and yes, even in the financial markets. In trading, in financial markets, these ratios are used to detect potential entry points and price targets. Let's see how. The theory is that markets move in waves, and after price begins a new trend, it usually moves in waves, retraces part of that move before continuing in the same direction, and then it continues its direction. Look at this chart. Now let's say you have detected that the market is in an uptrend and you want to enter a trade. Where is the best point to get in? Exactly, during a pullback, somewhere here. You want to buy when the price dips to a temporary low before resuming the uptrend. Fibonacci ratios help traders estimate where those pullbacks might end. We use Fibonacci ratios for this purpose. Many traders believe that these levels, these Fibonacci levels, represent potential areas where the price might pause or reverse, and price retracement often align with the Fibonacci ratios 0.62, 0.38, 0.24, and 0.5. Even though 0.5 isn't technically a Fibonacci number, it's widely used because it often marks significant corrections in price. Let's look at an example together. When the market trend is up and the price temporarily drops, one of the points where the price drop may stop and the uptrend may resume is the 62% Fibonacci ratio. The same logic applies to downtrends. If the price is falling and then starts to rise, the probability of a retracement occurring at the Fibonacci levels may be higher. Some traders believe that the probability of a retracement occurring at the Fibonacci levels might be higher. For example, imagine the price drops significantly, then it starts coming back up. You might see it stall and reverse somewhere near the 62% retracement level. Now you might ask, how can we be sure it will reverse exactly at one of these Fibonacci levels or somewhere there? The answer is we cannot. These are just probability zones. Areas where a reversal is more likely to occur. Areas some of traders believe that a reversal is more likely to occur. But let me tell you that there is an interesting psychological factor that makes these levels even more important. Here is where things get fascinating. Because Fibonacci levels are now so widely known and used by some of traders around the world, they tend to impact the market's behavior, even if there is no mathematical reason for them to work. In other words, Fibonacci levels often become self-fulfilling prophecies. Think about it. If thousands of traders are all watching the 62% Fibonacci level and planning to buy there, what happens when the price reaches that level? Exactly. Buy orders start flooding in, demand rises, and price bounces. Even if the level itself had no inherent power, the collective belief of traders tend to impact the market's behavior. So the more people know and act on Fibonacci levels, the stronger their impact. That's why these ratios 0.62, 0.5, 0.38 are often respected by the market. Now, if you want to apply Fibonacci in your trading, there are some important rules to follow. Rule number 1, detect the trend. Never use Fibonacci randomly. It works in clear trending markets. Rule number 2, wait for the pullback. When price retraces to one of the Fibonacci levels, don't jump in. Don't jump in right away. Just wait for confirmation. Rule number 3, treat Fibonacci levels as zones, not exact lines. They are areas of interest, not guaranteed reversal points. And finally, don't rely on Fibonacci alone. Use it in combination with other tools like moving averages or trend lines. Now, an important question. Is Fibonacci really a strategy? No, not exactly. Fibonacci trading by itself isn't a complete strategy. It's a technical analysis tool. A real trading strategy needs clear entry rules, when and why to enter, clear exit rules, when to take profits or cut losses, proper risk management, how much to risk per trade, and confirmation tools like indicators or price action patterns. So to summarize, Fibonacci trading helps you detect potential entry points, retracement zones, and price targets. And the collective belief of traders makes it even more important. Thank you for watching. Make sure to like this video, subscribe, and let me know in the comments what other strategies you would like me to explain next. Thank you.